On paper, nothing looked broken. The losses were unrealized, which sounded harmless enough. But the moment cash was needed, theory became reality. And those paper losses started counting very much. In March 2023, a chief financial officer at a venture-backed software company checked Silicon Valley Bank's quarterly report from December. Multiple CFOs later described nearly identical reactions in post-crisis interviews and reporting. The bank had disclosed $22 billion in unrealized losses on its bond portfolio. $22 billion. She remembered reading that number in January. She had noticed it, and then dismissed it. Because unrealized losses do not count. That is what accounting teaches. That is what regulators allow. That is what every banking textbook confirms. As long as you do not sell, the loss stays theoretical. On March 9th, when withdrawal requests started flooding in, she understood what she had missed. Unrealized meant nothing if you could not afford to wait. This is what genuinely confused me when I first tried to understand SVB's collapse. I kept seeing people say the bank had massive losses. But then other people would reply, those are just paper losses. They do not matter unless you sell. And technically, that second group was right. But I did not understand yet that being technically right stops mattering the moment reality forces your hand. If this breakdown is useful, the channel appreciates a subscribe. In financial accounting, there are two kinds of losses. Realized losses are real. You sold the asset. The money is gone. You report it. Investors see it. Regulators count it. Unrealized losses are theoretical. You still own the asset. Its market value has dropped, but you have not locked in the loss by selling. So accounting standards let you ignore it. This distinction exists for a reason. Markets fluctuate. Asset prices move up and down. If every temporary dip had to be treated as a permanent loss, financial statements would become chaotic and misleading. So the rule is simple. If you plan to hold the asset until it recovers, you do not have to recognize the loss yet. This rule has governed accounting for decades. It survived multiple financial crises. It is embedded in regulatory frameworks worldwide. And for most of banking history, it worked exactly as intended. When Silicon Valley Bank bought long-term treasury bonds in 2020 and 2021, they classified most of them as held to maturity. That classification carries a specific meaning. It tells regulators, we intend to hold these bonds until they mature and pay back their full value. We are not trading them. We are not speculating. We are committing to patience. Under held to maturity accounting, the bank did not have to mark those bonds to market value. Even when interest rates rose in 2022 and the market value of the bonds collapsed, SVB could keep them on the books at their original purchase price. The $22 billion loss existed in market terms, but it did not exist in accounting terms. Not yet. This was not a loophole. This was not evasion. This was standard practice. Banks across America were doing exactly the same thing. When you commit to holding bonds to maturity, unrealized losses are treated as temporary noise. The assumption is that time will heal the gap. Interest rates will stabilize. Bonds will mature. Full value will be returned. The loss only becomes real if you are forced to sell early. And banks are designed never to be forced. Here is what made SVB's situation different. Their depositor base was not typical. Most banks serve a mix of customers: individuals, small businesses, corporations. A stable, diversified base that withdraws gradually and predictably. Silicon Valley Bank served venture-backed startups and their founders. These customers kept enormous balances, millions, tens of millions, and they moved fast. When tech funding was abundant in 2020 and 2021, deposits flooded into SVB. The bank went from $70 billion in deposits to nearly $200 billion in less than 2 years. That growth looked like success. But growth created a structural problem nobody fully recognized at the time. All that new money had to go somewhere. So SVB bought bonds, long-term bonds, held-to-maturity bonds. The plan was to collect interest slowly over 10 or 15 years. The math worked perfectly, as long as depositors did not all want their money back at once. By early 2023, the tech funding environment had reversed. Venture capital slowed. Startups burned through cash reserves. Companies that had been flush with funding 12 months earlier were now drawing down deposits to cover payroll and operations. Withdrawals started increasing. Not catastrophically, not all at once, but steadily. Silicon Valley Bank had projected moderate withdrawal rates. Normal banking dynamics. What they did not anticipate was a coordinated loss of confidence happening simultaneously across their entire depositor base. On March 8, 2023, SVB announced it had sold $21 billion worth of securities, not because they wanted to, because they needed cash to meet withdrawals. And the moment they sold, the unrealized losses became realized. The bank reported a $1.8 billion loss on the sale. Suddenly, the accounting distinction collapsed. The loss that had been theoretical, patient, ignorable for months was now real, locked in, permanent, reported to the world. A fintech founder in San Francisco read the announcement that evening. This pattern repeated across hundreds of companies that night, documented in subsequent interviews and withdrawal data. His company had $12 million at SVB. He had seen the unrealized loss disclosures in previous quarterly reports. He had not worried. Unrealized meant it did not count yet. But once SVB sold, it counted. And if the bank had lost nearly $2 billion selling just a portion of its bond portfolio, what would happen if they had to sell more? He did not wait to find out. By midnight, he had initiated a full withdrawal. Here is when I understood the betrayal. The accounting rule was not wrong. Unrealized losses genuinely do not matter if you have time to wait. But that "if" is doing all the work. The rule assumes you will never be forced to sell. It assumes time is guaranteed. And at SVB, time was not guaranteed. The moment depositors needed cash faster than bonds could mature, the distinction between realized and unrealized became meaningless. If you are finding this useful, a like helps others discover it. The next morning, March 9th, thousands of other founders made the same decision, not because they thought SVB was insolvent, not because they believed the bonds were worthless, because once the bank started selling at a loss, the unrealized losses stopped being theoretical. The logic was coldly rational. If SVB had to sell more bonds to meet withdrawals, they would realize more losses. More losses would erode capital. Eroding capital would raise questions about solvency. And even if the bank was ultimately fine, did anyone want to wait through that uncertainty? Especially when moving money only required a few taps on a phone. By Thursday afternoon, $16 billion had left Silicon Valley Bank. A venture capital CFO later described the internal conversation that day. Multiple fund managers recounted similar deliberations in post-crisis reporting and testimony. Their fund had $40 million across multiple SVB accounts. The managing partners gathered on a call. One partner pointed out that SVB's bonds were still backed by the U.S. government. The underlying assets were sound. Another partner responded, "That does not matter if everyone else is withdrawing. They voted to pull their funds. Not because the bonds were unsafe, because the distinction between paper losses and real losses had stopped protecting anyone. Once the bank was forced to sell, the theory collapsed." This is the part that still stays with me. The accounting principle was designed to prevent panic. By letting banks ignore temporary market fluctuations, regulators thought they were creating stability. The rule said, "Do not overreact to short-term volatility." But what the rule did not account for was a scenario where everyone needed liquidity simultaneously. When deposits are stable, unrealized losses genuinely do not matter. When deposits flee, you are forced to sell. And the moment you sell, the loss that was theoretical becomes permanent. The protection was conditional. And the condition was the one thing banks are designed to avoid: forced sales under pressure. By Friday morning, California regulators had seized Silicon Valley Bank. The announcement cited inadequate liquidity. Not fraud, not recklessness, inadequate liquidity. The bonds were still there. The U.S. government was still going to pay them back at maturity. But maturity was years away, and depositors needed their money now. In the weeks after SVB's collapse, analysts reviewed the bank's financial disclosures. The unrealized losses had been reported. $22 billion. Disclosed in public filings. Visible to anyone who looked, the information was not hidden. But the interpretation was. Most readers saw that number and assumed it did not matter. Because unrealized losses do not count. Except when they do. A banking consultant who had worked in risk management for 15 years later admitted he had been wrong. His account appeared in multiple industry post-mortems examining what professionals missed. He had reviewed SVB's balance sheet in January. He saw the unrealized losses. He understood what they represented. And he dismissed them, because his entire career had taught him that paper losses were not real losses, that markets fluctuate, that patient capital wins, that forced sales are rare, but not impossible. And personally, this changed how I think about what gets dismissed as just accounting. I used to see phrases like unrealized losses or mark-to-market and think those were technical details that did not affect real outcomes. But SVB taught me that accounting distinctions are only protective when circumstances allow them to be. The moment cash is needed immediately, all the theory in the world stops mattering. What counts is what you can access right now. If this is the kind of breakdown you want more of, subscribing helps. The lesson was not that unrealized losses are meaningless. It was that they are meaningless only under specific conditions. Conditions that feel permanent until they are not. For decades, the distinction between paper losses and realized losses provided real protection. It prevented banks from panicking during temporary downturns. It allowed patient strategies to succeed. It worked, but it worked because time was always available, because forced sales were rare enough to be exceptional, because depositor bases were stable and diversified. At Silicon Valley Bank, none of those assumptions held. What stayed with people was not the accounting mechanics. It was the feeling of watching something technically correct become practically irrelevant. The bonds were safe, the losses were unrealized, the accounting was compliant. And none of it mattered. Because theory only protects you when you are not forced to act, and once you are forced, the distinction collapses instantly. This is what SVB's collapse revealed, that the line between paper losses and real losses is not fixed. It is conditional. And the condition is not the quality of the asset. The condition is whether you can afford to wait. Not because anyone lied, not because the rules were broken, because circumstances can make theory irrelevant faster than accounting can adjust.